In this second bulletin of income tax bi-weekly, we'll discuss on the income tax issues, updates and developments in the bygone 2 weeks. We'll discuss on why the CBDT is concerned with the ex parte orders due to wrong or non-service of the notices. We'll discuss on why TDS under 195 may not be deducted for services which are rendered totally outside India, why GCCs are information technology enabled services and not KPOs. We'll discuss on why trust, just because they are generating surpluses or associations, cannot be taken out of income tax exemption, and we'll also discuss on why foreign exchange losses need to be booked every year in the income tax returns and not once when you are making a payment of the liability or loan. So first up is a concern of the CBDT and also the taxpayers on the ex parte orders. Why are these ex parte orders taking place? Because the email IDs and the mobile numbers on the income tax returns are different from what the taxpayers are using. Now, there might be various issues. Maybe these email IDs or mobile numbers are being used by the earlier consultants of the taxpayers, or maybe the consultants of the taxpayers to whom these notices are delivered on their email or mobile numbers, they are getting missed. It may also be the case that the email ID or mobile number on the ITR is different from that on the income tax portal. Now, whatever the case may be, in case it is not an effective service of notice as held by the Madras High Court in the case of Jai Infotech, then it may be remanded back by the High Courts and the Supreme Courts. The same was the case in the case of General Traders, where the Jharkhand High Court has remanded back the case for de novo assessment, where the notice was delivered to a wrong email ID and mobile number which was not being used by the taxpayers. Please note that the current section 282 of Income Tax Act 61, which is for services of notices, has been changed to section 501 of Income Tax Act 2025, and the word or after each limb has been removed. What is the significance? That the Ministry of Finance CBDT is itself, in our view, accepting that the notices need to be delivered in more ways than one. It may be delivered by email ID, mobile number and even by speed post to ensure that the notice is delivered and the assessment is effective. As a taxpayer though, you need to also sanitize your database irrespective of whether the CBDT conducts an intensive review of the databases. Now, second is whether a TDS needs to be deducted, say on a payment to a foreign agent as a sales commission for selling the goods outside India. In such cases where the services are totally rendered outside India, no part of the services are rendered in India, then the income cannot be said to accrue or arise in India. In case the income itself does not accrue or arise in India, as also held in the double taxation avoidance agreements, then there is no question of TDS under section 195 of the Income Tax Act. The same was held by the Honorable Madras High Court in the case of Faizan Shoes. But as a taxpayer, you need to be aware, you must take Form 15CA or 15CB from a chartered accountant in case applicable, so as to protect yourself. Now, section 195 of Income Tax Act 61 gets converted into section 393 of Income Tax Act 2025, which you may read, and it is almost the same. Next, foreign exchange losses on monetary items which are not fixed asset, inventory or investments, like for payables, receivables or for loans. In such cases, these foreign exchange payables or receivables need to be reviewed every year, and the foreign exchange losses, if any, on 31st March, year on year, it should be booked, even though not realized. These losses should not be accumulated, and once and for all, a foreign exchange loss should not be booked after 3 to 4 years in the year of payment or repayment of the loan. That is required as per Rule 5 of Income Computation and Disclosure Standards, ICDS 6. In case it is not done, then it is a violation even of section 43AA of Income Tax Act 61. And in the case of Hyderabad Yadgiri Tollway, it was held by Honorable ITeS Hyderabad that in case foreign exchange losses are booked once and for all in the year when the loan or payment is made, then it can be disallowed subject to only the loss which has arisen in that particular year. Therefore, the assessees need to be careful that all your foreign exchange payments you need to reinstate as per Accounting Standard 11 in the year, every year 31st of March, and take the deduction in that year in income tax returns also to be compliant with the law. Now, Global Capability Centers, or GCC as we commonly call it, are the focus area of the Government of India. Now, say for example, there is a engineering GCC, a GCC which creates maps and designs for the associated enterprise outside India, its mother company or its associated company. Now, the question is whether it is IT enabled services or whether it is rendering KPO, knowledge process outsourcing services. And why it is important? It is because generally the profitability in India for ITeS is much lower than KPOs, and therefore it is a transaction pricing issue, transfer pricing issue, right? So, both ITeS and KPOs, they are rendered by means of a software, and they are rendered by technical resources. However, the main point of difference is that in case of KPO, there is a requirement of advanced analytical and technical skills. In case a GCC can prove that it is rendering services which does not require advanced level of analytical and technical skills, then it can be considered as IT enabled services, and the same was held in the case of DGS Technical Services by the Honorable ITAT Hyderabad. So, all the GCCs, you need to take care of this judgment. You can take it and you can review as per Rule 10TA of the income tax rules whether you are a ITeS or a KPO, and accordingly a transfer pricing adjustment can be made. Coming to trust, many of the trust associations have huge surpluses nowadays. And how do they have such huge surpluses? Because they have seminars. These seminars have huge sponsorships, have huge participation fees, and consequently huge surpluses. The question is that in case there is a huge surplus of a trust or an association, then can it be considered as a exempt entity under section 11 read with section 2 subsection 15 of Income Tax Act 61? Well, two things need to be seen. Number one, whether consistently such trust has been assessed as an exempt entity. If it has been, then as per rule of consistency envisaged by the Honorable Supreme Court in the case of Radha Swami Satsang, it cannot in a year suddenly be taken out of exemption. The earning of surpluses cannot only be a reason why the exemption should not be allowed to a trust which is otherwise rendering services of a charitable nature as per section 2 subsection 15 of the Income Tax Act 61. Therefore, the same was held in the case of Neuro Update Chennai by the Honorable ITAT Chennai. all the trusts and associations from the last 15 years or so after 2009-10, they are facing huge litigation and can take the benefit of this judgment of the ITAT Chennai. In case of Income Tax Act 2025, the trust non-profit organization, they go through a huge revamp. All the provisions are clubbed at one place from section 320 approximately, and section 2 subsection 15 becomes section 2 subsection 23. There are few changes also therein which principally change the way one has to look at trusts in income tax. So one need to read Income Tax Act 2025 also, especially the non-profit organizations. So friends, thank you very much for watching this video. Please do like, share and subscribe to this channel. Thank you very much. Stay tuned.